The RBA has just come out with a shocking announcement. The RBA has given the green lights for the banks to lend and take on more risk, and they said they want higher asset prices. In this video, I'm going to go over Reserve Bank Governor Philip Lowe's speech on Thursday, where he spoke about what the Reserve Bank is going to do next month. If you think the Reserve Bank's decisions doesn't affect everyday Australians' lives, it definitely does. The Reserve Bank of Australia has effectively greenlit risk-taking on property investment, and the biggest change in policy in 27 years has not only triggered a home loan war, but has also raised the prospect of another house price bubble. A day after RBA Governor Philip Lowe's bombshell speech, mortgage lenders were preparing for intensification of an already brutal battle for market share and a resulting sharp increase in house prices. So this is something we definitely have to pay attention to, because if all of a sudden the banks start giving out easy loans, this could fuel another housing market bubble. Dr. Lowe said record low rates were locked in for at least another 3 years, because the bank would not raise them until the actual not forecast target inflation was reached, and the asset price bubbles could now actually help boost economic growth. I can't believe he just said that. He's now going out there, blatantly say it. He's not beating around the bush now. He's now saying that a bubble could help fuel economic growth. Well, it could fuel economic growth for the rich, but what about those young Australians struggling to get into the housing market right now? It's only going to make it harder for them. It's only going to broaden inequality. What do you think about this? His bombshell, which included signalling substantial new bond purchases known as quantitative easing, aka money printing, lifted Australian shares to a 7-month high on Thursday and sent the currency to a 2-week low. The market slipped 0.54% on Friday, but the larger bond buying program and further interest rate cuts are expected to support stock valuations. So before, the Reserve banks and central banks would try to say, look, our policies, we don't do it to increase asset prices, we don't do it to increase the stock market or house prices, but we all knew they did do that, and we all know that they knew that their policies would increase asset prices and not necessarily help the bottom 50%, but help more the top 20, 10, even 1%. So what you need to know about quantitative easing is the Reserve Bank has now stepped in the market. They're manipulating the market. They're buying government bonds to reduce the yield on those bonds so the government can borrow cheaply, because there's not much more the Reserve Bank can do than other lower interest rates for the banks to lend out to customers to fuel the economy, and to drop the rates on government bonds so the government can borrow cheaply and use more fiscal policy or government spending to boost the economy. And the stock market loves it when central banks do more quantitative easing, more money printing. They love it when government spends, and they love it when there's more credit, because they know that fuels asset prices, and they try to price this in before it happens. While the banks signal for another cash rate cut to just 0.1% on Melbourne Cup Day has been seen as adding little extra stimulus, the lock-in of lower rates for longer at a time of relaxed responsible lending rules is expected to reignite the loan market and house prices. So the Reserve Bank has started doing something called forward guidance, and they're actually using this as a tool now of their monetary policy. So now the central bank should be very secretive on what they're going to do. But now they're going out and they're actually saying what they're going to do before they do it, hoping that it'll actually stimulate the markets so they won't have to do as much stimulus. Like when the Federal Reserve in the US said they're going to start buying corporate bonds. Well, what happened is investors jumped into the corporate bond market and started buying up a whole bunch of corporate bonds so they didn't have to buy as many. So they've all but confirmed there will be another rate cut on Melbourne Cup Day, and in a normal market this could fuel house price growth by lowering interest rates. But the responsible lending laws being axed, that could be even stronger than changing interest rates from 0.25% to 0.1%, because that won't make much of a difference. But moving responsible lending and making it much easier to get a loan, that's what could really fuel asset prices, as it's supply and demand. If there's more people that can go and get a loan and bid up property prices, that could fuel house price growth. But this isn't a normal market. We have halted immigration, we have JobKeeper and JobSeeker being removed, so that's taking billions and billions of dollars out of the economy, and then that's going to have a flow-on effect to the businesses where those people would normally spend. then they may reduce business, then they may have to let people go. So we have to see how this plays out. We've also got mortgage holidays coming to an end in March. We've got businesses trading while insolvent. We've got falling rents and people moving back in with mum and dad. So that's going to reduce housing demand as well. Along with a 27-month high in Westpac's consumer confidence reading this week, the sharpest recovery in history of the series, the time to buy a dwelling index increased by 10.6%, its highest level since September 2019. So we are seeing consumer confidence and a lot of confidence to buy right now because we're kind of in the middle of this recession. We've had all this money thrown at us. We've had the super withdrawals. We've had JobKeeper, JobSeeker. Some people have been making more money on that. We've had the cash payments by the government. We've got tax cuts coming. So that means people's disposable income will increase. So then when you apply for a loan, borrowers may be able to borrow more money. And again, if they've got more money they can borrow, then that's more money they can use to bid up house prices at auctions or when they're just putting an offer on a house. So everything seems really good now, but we haven't hit the recession part of this recession. And I expect that will come next year if things don't recover quickly. Property prices have dropped 5.5% in Melbourne since the onset of the pandemic, and Sydney's prices have slipped a more moderate 2.9% according to CoreLogic's data. Newcastle Permanent Group Treasurer Brian Reid, who runs a home loan book with lower arrears than the big four banks, said there was definitely a home loan war underway that could fuel property prices. At its November 3 board meeting, the Reserve Bank is likely to not only cut the cash rate, but also reduce the rate it pays commercial banks on money held in so-called exchange settlement accounts with the central banks. Cutting that rate would also further incentivize banks to push harder on lending. And so what this is banks can deposit money with the central bank and get paid interest, just like how you deposit your money with the bank to get interest. But with interest rates so low, you're not going to get any return. So this is going to incentivize banks to lend, and it's also going to incentivize everyday Australians, instead of having money in their savings account and not getting any return, they may put it in shares or property, precious metals, cryptocurrencies, because they're not getting any return there. So it's going to force them into riskier assets, or people will say, look, I'm not getting savings, and they may be more likely to spend. And here's something that's really shocking. The RBA says that it will deal with asset prices at a later date, Mr. Reid said, and Westpac Chief Economist Bill Evans agrees. The RBA has always been troubled by the interaction of lower interest rates and asset prices, in particular house prices, Mr. Evans said. But we all know that the RBA knows that fueling house prices is the last trick we really got in Australia, besides digging holes in the ground and selling resources. So the RBA, what happened in March, the RBA was so scared that, property prices could fall. They were considering shutting down the real estate market and stop reporting on housing data, because they didn't want, people to get all fearful in the property market to crash, because they know how much the Australian economy relies on the housing market. And also what the RBA is going to start doing, and this is going to affect you, it's going to affect your money in the bank and your Australian dollar. They're going to start buying longer term government bonds. So right now we're seeing 3-year fixed rate mortgages really cheap, because the Reserve Bank of Australia started something called yield curve control, where they buy 3-year government bonds to reduce the yield on that. So banks and the government can borrow at very low interest rates. But now what they're going to start doing is buying 5-year and 10-year government bonds. And so what that will do is that will reduce borrowing costs for longer term. And also the reason why they said they're going to do this is because they want a lower Australian dollar to import inflation. And just 2 months ago they were saying the Australian dollar is too high, they want to lower it, but they're not going to intervene in the market. But they always say this, they say they weren't going to drop interest rates to zero, they said they weren't going to do quantitative easing, they're never going to tell it to you straight, they haven't got your best interests at heart, they're not being transparent with the Australian people, and it's something that really annoys me. And what this is going to do is, like I said, it's going to help asset prices, it's going to create more inequality, it's going to devalue your money, it's going to devalue the Australian dollar, it's going to devalue your purchasing power. And now the RBA has actually given up on inflation, or their inflation target. They said they're not going to worry about inflation now, but if they keep doing quantitative easing, if banks all of a sudden start lending lots of money and lots of money starts going in the economy, we've had deflation now, but once everything opens up and then people start spending again, we could see inflation start lifting up again. and they've even noted this at the Reserve Bank, but they said they're not going to worry about it right now. Part of the RBA's new policy stance is the bet that the actual inflation will not be back for years, and even when it does come back, it could overshoot the bank's 2 to 3% target. Looking at where inflation has been rather than where it might be going is really just green lighting risk-taking, Mr. Tooley said. In effect, the RBA has confirmed they're not going to take away the punch bowl for at least 3 years. So what does this mean for everyday Australians like you and me? This means there could be higher asset prices like stocks, real estate, precious metals, with all this money printing going on. And also what it means is it could fuel more house prices growth, because at the end of the day, lower interest rates, easy lending is what fuel house prices. But, and this is a big but, how is the economy going to recover? Because that's what normally happens in a normal market. But we've still got all these risks in the economy, like I said. So we've got these two forces battling out. We're really going to have to monitor this to see what's really going to happen. It's very hard to predict in these uncertain times. And we also don't know what's going to happen with the pandemic in the future. So what do you think? Do you think this is going to lead to another housing market bubble and fuel more house prices growth? Or do you think the risk in the economy are too great and that later in the year we're going to start seeing the real pain once all this stimulus starts being taken away? Again, what you have to remember is the property market isn't just one market. So when they put out these predictions, it's just averages. You have to get out in your market, what type of property you want, because prices could be booming in one part of the city and be dropping for one part of the city. Units could be going up while houses are going down, and vice versa. Houses could be going up while units are going down. So make sure you get your property type, your suburb, and really do your research on your market. For all my loyal viewers and subscribers still watching, you're awesome. And if you haven't already, smash the like button for the holy YouTube algorithm. It really helps out the channel a lot. And if you haven't, subscribe. I'll keep you all up to date on the latest property market and economic news in Australia. And of course, I'll see you in the next video.